Welcome to Lloyd's List on the Radar on Friday the 31st of October, bringing you a roundup of the top stories in the shipping industry this week. It's been another week of misery in the markets, with more ship owners running into financial difficulties and others forced to issue denials that their business is at risk. In our top story this week, dry bulk owners and operators risk breach of their loan conditions and even bankruptcy after a record drop in second-hand ship values. Brokers and analysts told Lloyd's List that falls in asset values linked to loans will be a big problem now that the second-hand cost of a Capesize vessel has dropped to around $68 million from an all-time high of $153 million in July. Tufton Oceanic Research Director Andreas Vagotis predicted that as much as a fifth of the world's listed dry bulk companies could soon have a negative net worth based on fleet value compared with their outstanding debt. At least 2 companies have declared bankruptcy this month, and liquidity problems at Britannia Bulk are being seen as the first signs of the effects of falling ship prices for many listed dry bulk companies. The fears have fed into the sale and purchase market, which has dropped dead according to Asian market sources. Lloyd's List has been told by the sale and purchase manager of a dry bulk operator that no one is willing to buy a bulk ship in the market at the moment. This has had the effect of removing the market price, as there is no transaction to set the benchmark. The falling oil price is putting owners of offshore vessels and rigs under pressure to reduce rates as developers of deep-water oil projects consider delay or cancellation as costs rise. Oil and gas producers are already shelving high-cost onshore energy projects, with a 60% fall in oil prices from $147 a barrel in mid-July to around $60 a barrel this week. Deep-water projects in Brazil, the Gulf of Mexico and West Africa are becoming uneconomic in a market when drilling rig and offshore vessel rates are at record levels. Deep-water capable drilling rigs are being hired out at $600,000 per day, and oil companies are willing to pay more than $130,000 per day for subsea support vessels, and $300,000 day rates for rig towing anchor handlers. With the turmoil affecting dry bulk owners and operators, it's no surprise that the market has continued to slide further. The Baltic Dry Index has dropped to 3 digits, falling 221 points on Thursday to 885 points, a new 10-year low. Supramax vessels are commanding the most interest, with the average time charter rate on Thursday at around $6,400 per day, still higher than the Capesize average time charter rate of $6,300 per day. Brokerage Fearnleys reports hardly any activity in the Capesize spot market, and when vessels do fix, rates are barely covering running costs, with iron ore being shipped from West Coast Australia to China for as little as $5 per tonne. In the transatlantic market, a Capesize vessel can be chartered for around $4,900 per day, lower than the rate for a Panamax on the same route of around $5,700. With plenty of prompt tonnage in the Atlantic, fixing needs to rise before rates stand a chance of being pushed back upwards. A downturn in second-hand ship values is also affecting the container ship market, where some brokers have stopped conducting valuations, except for regular clients who agree to sign strict disclaimers. In the container charter market, fixtures are few and far between, but deals that have been fixed have sent indices plummeting. Business that is being done is mostly for very short periods. A vessel of nearly 1,300 TEU has been chartered for 10 days at $8,750 per day. In the large tanker market, owners drew a line of resistance this week, refusing to fix below World Scale 70 as traders came into the market for November loadings. The Baltic Exchange indice for the benchmark Middle East Gulf Japan route fell from World Scale 76.8 at the start of the week to World Scale 70.3 on Thursday afternoon. More than 5 charterers were completed around this level, representing earnings of about $40,000 per day. Owners were also looking forward to a fourth quarter lift in the Aframax market, with business increasing in both North Sea and cross-Mediterranean regions. Earnings in the cross-Mediterranean market were running at World Scale 210 and in the North Sea at World Scale 170. Rounding up the week's other major stories. The European Commission has told container industry leaders that ocean carriers cannot expect a block exemption from EU competition rules for cooperative arrangements that exceed a 30% threshold. But the Commission has reassured ship owners that the practice of operating tanker, bulker or reefer ship vessels within pools is not under threat from the Competition Directorate. Evergreen Marine has posted a 94% drop in its third quarter net income to $8.8 million, its lowest quarterly earnings in 2 years. The world's 4th largest container shipping line said its sales in the 3-month period fell 16% and its profit for the first 9 months of the year plunged 78% from the same period last year. The bill for damage caused by Hurricane Ike is mounting, with rising insurance claims set to make it the third most costly US windstorm. Lloyd's of London said initial claims faced by its members would reach $2.3 billion and give an estimate of the industry's total exposure of $20 to $25 billion. Christmas has come early for Peter Georgiopoulos thanks to a $30 million cash payment he will receive next year as part of General Maritime's acquisition of Arlington Tankers. Mr. Georgiopoulos, who has been appointed chairman of the expanded company, will forgo his 2008 bonus and receive $8 million in cash on January 2nd next year, and a further $22 million on July 1st, 2009. For more information on these stories and many more, plus information on our continuing anti-piracy campaign and reports on how the global financial crisis is affecting shipping, please visit lloydslist.com for breaking news and to view our online e-paper. Thanks for watching On the Radar.